Hello everyone, my name is Marilena and I will be your hostess for today. Together with me I have Peter, our senior market analyst at IronFX. Hello Peter.
Hello.
Thank you for joining us today as we're looking at the fundamentals and driving the markets currently. So Peter, how have the market behaved since yesterday?
Well, we had a relative inactivity of the US dollar as well as US stock markets. It was a rather slow Monday. I would note, though, that on the fundamental side, we have a couple of issues. The first issue would be the worries about the Chinese intentions over Taiwan and whether there's going to be further escalation with a possible military operation on behalf of China. That's a big issue. And it's an issue, despite the possibility of such an event being rather remote, given that Russia has invaded Ukraine, and given that the stakes are pretty high, because the Taiwanese straits are one of the busiest shipping routes worldwide, and should there be such a development, we may see US sanctions being applied on China, and that could slow down the economic outlook, not only for China or the US, but on a global level. Mm-hmm. We highlight that as an issue which has to be watched out for. Other than that, we note scorching temperatures across Europe, and that has practically multiple effects. On the one hand, that increases the energy consumption in the European states in order to cool homes down, and at the same time, we note that the Europeans are getting a reduced supply of Russian natural gas. At the same time, we have Norway, which seems to be moving towards limiting the supplies of natural gas to Europe as well. So that's another issue. As a side issue of the high temperatures, we note that shipping routes within Europe, say like rivers, have slowed down, given that some parts, say for example of the Rhine, have been closed as the water levels are very low. And that could slow down the growth rates for the European continent even further. Mm-hmm. Other than that, I would highlight also the raid on former US President Trump's house in Florida, Mar-a-Lago, as we had FBI agents which raided the house in search of any documents which the former US president may have or may not have took with him as he left office.
Mm-hmm. And what earning reports would you highlight for today?
Well, on the earnings, I would be noting Coinbase and I would be noting also Avast. Uh-huh. And I would also note from the US stock markets the dividends of IBM. Mm-hmm. That's all of that is for today. Could create actually some interest. Uh-huh. But given the slow start of the week, it's pretty doubtful on whether it's going to be moving the markets. The markets are seen to be preparing for the release of the US CPI rates tomorrow. Mm-hmm.
And what's on the calendar for the day?
It's a pretty slow Tuesday. Mm-hmm. We have no high impact financial releases today. Okay. Fundamentals most probably will be leading the direction of the markets, both on the FX front as well as on the stock markets. Mm-hmm. I would note, though, that just before the Asian session, we have the AP weekly crude oil inventories figure. That would be of interest for oil traders. I would also note during the Asian session tomorrow the release of the corporate goods price growth rates from Japan. Should there be an acceleration, we may see JPY getting some support, as that would imply practically that we are having higher inflationary pressures within the Japanese economy still. What else? I would also note from China the inflation metrics for July, both the CPI as well as the PPI rate, and that could also have an effect on the Aussie. Mind you that during today's Asian session early in the morning, we had the release from Australia of the business conditions and the business confidence. Both improved substantially, and that was a positive indicator for the Australian economy, as practically optimism seems to be on the rise, and at the same time conditions in the Australian economy seem to be improving.
And how about the oil prices?
Now, on a fundamental level, oil prices rose a little bit, WTI prices rose a little bit. On a fundamental level, the big issue for oil prices is the Iranian nuclear deal. It seems that the EU, the US, and Iran are moving closer to a possible deal to reinitiate the nuclear accord between them, and that could allow practically Iran to re-enter the oil market as a major supplier, providing practically a boost to the supply side of the commodity and could weaken oil prices. By the way, oil prices seem to remain at or below the level of $90 per barrel. In our opinion, that seems to be rather bearish. I would expect actually oil prices to have risen somewhat. They did not, and we may see them rolling down lower should such expectations about the increase of supply from Iran in the oil market actually be realized.
And now moving to the precious metals, is gold price relatively stable?
Well, yes, it is. Practically, we have still the negative correlation of the US dollar with gold's price, and given that we have a relatively inactive US dollar, practically gold's price is mirroring that. I would be highlighting the US CPI rates for tomorrow as the next key risk event for gold's price. And gold may find itself in a relatively peculiar position, given that on the one hand it has a negative correlation with the US dollar, on the other hand gold as such is also used as a hedging instrument against inflationary pressures. Now, should inflationary pressures actually slow down, that could cause gold's price to drop a bit. On the other hand, should the US dollar drop, that could push gold's price higher.
Any final comments?
The big question is whether the inactivity is going to be continuing today as well. It's the big issue, and should that be the case, we may be in for a slow Tuesday.
Great. Thank you, Peter, for your time, and everyone for watching. Join us after a short break for technical analysis with Peter Yosif.
So welcome to the technical analysis part of the presentation for today. We have in front of our screens right now the 4-hour dollar of the US dollar index. Overall, the charts which are to be presented are to be in the 4-hour chart, unless otherwise stated. So let's have a look at the US dollar. The index seems to have some bearish tendencies. It's currently testing the 105.90 support line. It's actually about to break it. And we would note also that the RSI indicator has been dropping and has also broken below the reading of 50 with a downward slope, so the bearish tendencies are present. Overall, though, I would be calling in the bears and the bearish outlook for the index should the price action actually break clearly the 105.90 support line, and I would also require clear breaking of the downward trend line, which has been guiding the index. Let's have a look since this is the daily chart, since around the 9th or 10th of August, sorry, 9th or 10th of February. So we would require the price action of the index to break the 105.90, definitely break the prementioned upward trend line, and start aiming for the 103.45 support line, which provided support back around the 25th, 27th of June. Other than that, we note lower the 101.25 support line, which seems to be finding support and actually providing support for the index on the 30th of May. I see that there is a request to have a look for a level even lower. It's a very extreme bearish scenario in my opinion, but nevertheless, let's have a look. Drilling back out to the daily chart, I would be noting this resistance line here. That would be the 99.50 resistance line. Given that the price action now is higher, could serve as a support level as there is an interaction and a switch in the rule. Even lower, we may note the 97.70 level. But overall, these are extremely bearish scenarios and in my opinion are very, very remote for now. I would be concentrating more, let's readjust, on the breaking of the 105.90 support line. Definitely we would require clear breaking of the upward trend line incepted since the 10th of February before switching into a bearish outlook from the current sideways bias for the index. Should the stabilization take place, I would expect the price to remain around or just above the 105.90 level. In the case of a bullish scenario, would require a breaking of the 107.20 that is resistance line, and that would have to be a clear breaking upwards and start aiming for the 109.10. For the time being, once again, this does not seem to be the case, given also the bearish tendencies expressed for the US dollar during today's European session. Let's have a look at Euro USD. Euro USD, which has been understandably on the rise, but the overall sideways movement seems to be maintained and would still maintain that. And as long as the price action remains between the 1.0275 resistance line and the 1.0110 support line, we tend to maintain a bias for sideways motion of the pair. In case of a bullish movement, given also that the RSI indicator has moved considerably above the reading of 50 and is actually now aiming for the reading of 70, it's at 59.60 almost. Excuse me. We may see the price action of Euro USD rising, breaking the 1.0275 resistance line clearly, and start aiming for the 1.0380. It's not much. The distance between the R1 and the R2 is about 105 pips, so that should be doable for Euro USD within the day. On the flip side, should the bears take over, we may see the price action dropping. Definitely we would require clear breaking of the 1.0110 so that we move out of the sideways bias in favor of the bearish outlook, and we may see the price action once again starting to aim parallel level. For the time being, we maintain a bias for a sideways movement between the 1.0275 and the 1.0110, yet bullish tendencies may exist, especially given that the US dollar seems to be weakening in today's European session. Mind you, on the other hand, that the euro may fundamentally be also a little bit depressed, and the fundamental picture for the European economy, exactly to be more exact, Eurozone's economy, it's not the brightest at the moment. It's characteristic that in addition to the problems Europe has and faces regarding the supply of natural gas, and now we have very high temperatures in the European continent, which may force European countries to actually consume even more energy in order to cool places down, homes and offices. And that may also imply practically a high consumption of natural gas, practically dwindling out the reserves the continent has. As a side issue, I would also note that the level of waters in various rivers, and especially the Rhine, which is a main shipping route for German manufacturers, seems to have dropped, and even the Rhine at some points has closed, which may be slowing down the European production levels. Okay, let's have a look now at GBP/USD cable, which seems to have found some support on the 1.2070 support line. Now this is a peculiar issue here on two reasons. On a technical level, in the past few days, we had a clear downward movement where you saw practically lower peaks and lower troughs. But the weakening of the US dollar practically caused cable to jump a little bit higher during today's European session. And that technically provided practically a breaking of the pre-mentioned downward trend line, which had been guiding the pair. And that was since the beginning of August. Let me have a look. Yeah, since the 1st of August. So, given the breaking of the downward trend line, given also that the latest trough is not as low as the previous one, the stabilization seems to be occurring. And that forces us to switch our bearish outlook for cable in favor of a bias for sideways movement of the pair, probably between the 1.2185 and the 1.2070. It's actually right now in the middle. Most probably that should be it. I wouldn't be surprised to see it rising even a little bit higher yet, respecting the 1.2185, which provided resistance here, so, and support here. So it's a pretty valid level. It's not just a random one. Anyway, should the bulls take over, I would require clear breaking of the 1.2185 before calling in the bulls. And in such a case, we may see the price action actively aiming for the 1.2330 resistance level, which provided resistance back here. That was around the 27th of June. Some implied also the peak here to be another level. Could apply. I wouldn't say no. That would be a little bit lower and near the 1.2295. I'm still preserving the 1.2330. But it's something which could be taken notice of. In an extreme bullish scenario, we note the 1.2480 resistance level. Now, should the bears take over once again, we may see the price action reversing direction, breaking the 1.2070 clearly, and start aiming for the 1.1935 support level, which provided support here and here. well as resistance here and support here. Yeah, bearish scenario, I would require that breaking of the S1 and start aiming of the S2. On the other hand, we have to note that the market sentiment seems to be a little bit undecisive. The RSI indicator below our 4-hour chart has risen a bit, broken just above the reading of 50, and seems to be stabilizing somewhat, which more or less tends to imply that the market may be a little bit undecisive as for the direction of the pair's next leg and may stabilize somewhat. On the fundamentals, definitely the release of the US CPI rates for July tomorrow may have started to be priced in by the market, and that would possibly explain also the weakening of the US dollar, as the CPI rates are expected to slow down both on a month-on-month as well as on a year-on-year level. So some investors may be speculating, why wait until tomorrow, start selling the dollar now. That's quite plausible scenario. On the other hand, though, I would note that practically we would have also some fundamentals which are conflicting about the UK. I would highlight practically the rally of the two main candidates for the leadership of the Tory party and being the next Prime Minister of the UK. And Liz Truss's statements about BOE are not exactly encouraging. That's another issue. And the criticism that she addressed towards the central bank. On the other hand, you have former finance minister, Chancellor of the Exchequers, Rishi Sunak, which had thrown the idea on the table of possible subsidies for inflation. However, that could macroeconomically drive inflation even higher. So it's a little bit wait and see. Of course, politician promises in pre-election periods, you understand, they're always high, or at least higher than what they can achieve. So that's a big issue. Let's have a look now on USD/JPY. And we're talking about the definition of a stabilization here. Note how practically there are no, if any, volatility for the price action of USD/JPY since yesterday of the full day. So practically 1, 2, 3, 4, 5 candlesticks or 4-hour charts. So the sideways movement seems to be maintained, but, and this is a big question, on the other hand, we have an upward trend line which has been guiding the pair since the 2nd of August. Note how it went higher. This is the stabilization of today, and it seems to be going upwards. Now the big question is whether should the stabilization be maintained, it will be bound to reach the upward trend line, and that's the cutoff point. Will USD/JPY rise higher, or will it remain stable and break the upward trend line? Now, as long as the upward trend line remains practically valid, we tend to maintain a bias for a bullish movement of the pair. However, that may not be the case, and the pair may remain stable, in which case it would break the upward trend line, and that would force us practically to switch our a bullish outlook in favor of a bias for sideways movement, possibly above the 134.70. Note how it provided some support around here. So the big test, or the first big test, would be the upward trend line, whether that's going to be maintained or not. On the other hand, should the price action drop, break the 134.70, break also the upward trend line and start aiming for the 132.75, that would be an indication about a possible bearish scenario. Why? Because it would practically start marking a breaking of the upward trend line, a signal for a trend reversal, and at the same time, lower peaks and lower troughs should start forming as the pair moves towards the 132.75 support line, and that would practically imply a bearish tendency. Now, on the case of a bullish scenario, we may see the price action bouncing practically on the upward trend line, aim higher, and start aiming for the 136.75, if not break it. Note how the pair moved around 270 pips, and that was on the 5th of August, on Friday. I know it was an intense market reaction, but you can see an even a wider upward movement of the pair. And that was on the 2nd of August, of this time over 320 pips. So practically the possibility of the pair rising and moving upwards by 200 pips is quite possible within 24 hours. It has done it before, it can do it again. Will it do it now? It remains to be seen. For the time being, we tend to maintain a bullish outlook. I wouldn't be surprised to see the price action breaking above the 136.75 in the bullish scenario and landing somewhere above it. On the other hand, though, the stabilization of the pair seems to imply that the price action and the upward trend line are on a collision course. And should the trend line be broken, that would force us to switch our bullish outlook in favor of a sideways movement initially. Last but not least, the possibility of a bearish scenario. We may see the price action breaking the 134.70, breaking the downward trend line, yet we would require the price action to actively aim for the 132.75 support line, which provided support here and here. Okay. Let's have a look at the second safe haven, but before we move to CHF, a small word about the fundamentals surrounding JPY. Now, JPY, as we well know, is also considered, besides a national currency, also an international safe haven for investors. Given that we have high tensions around China with Taiwan, should there be any further escalation, that could provide support for JPY. On the other hand, though, we could see also the US dollar being in the role of the safe haven itself, and should the safe haven inflows favor the US dollar rather than the JPY, that could cause the pair USD-JPY to be on the rise. Also see that there is a request to label a chart with its name. Okay, we can definitely do that. And it will be in black color. A bit wide below. Okay. Even a wider. Let's do the 28. Okay. That should be readable. Let's move now to USD-CHF, the other safe haven. Now USD-CHF, in contrast to USD-JPY, note how the USD-JPY is moving upwards. In this case, we have a clear strengthening of the US dollar against the Japanese yen. On the other hand, we have USD-CHF, which is also safe haven. And note the drop of the past 24 hours. It's quite intense, and the pair has broken the 0.9550 support line, practically abandoning the sideways movement it had since the, let's have a look, since the 2nd of August up until, I would say, yesterday or today during the Asian session. But it's more clear today during the European session as it has moved decisively lower. That forces us to switch the role of the 0.9550 from a support line to resistance line, given that the price action is below it. And let's go hunting for a new support level just below. Let's loosen this up, and here we have it. Let's readjust slightly in green, please, and that would be the 0.9285 support line. Let's make the necessary corrections, adjusting. Also the labels will need to be corrected. It's characteristic how the USD is weakening on the one hand. On the other hand, though, CHF may be slightly strengthening. And that's driving the pair lower. 0.9730, the ultimate resistance line for now. The mid resistance line is now being placed at 0.9640. The 0.9550 is now turned into resistance line from a support line. First support line is being placed now at 0.9455. Second support line is being placed at 0.9375. And the final support line is being placed at 0.9285. Also, let's name this. USD CHF in black. And let's move now to commodity currencies. We make a start with USD CAD. Okay, the wide sideways movement seems to be maintained. Maybe a little bit too wide, but may I remind you that the 1.2945 resistance line was tested extensively, so that's pretty valid. And also the 1.2780 as support line was tested. There are those some, yes, there. The viewer now suggests the mid-level around the 1.2820. Let's have a look at it. Yeah, I understand what you mean. 1, 2, 3. Yeah, That could be possible, yeah. But in my opinion, I would raise it a little bit higher, 1.2830, and I would be getting all this here, and here, and here. Okay, there was a break here, but it was a short one. So that could be also mid-level. For the time being, though, I would delete this. I would maintain the 1.2780 as support line for the current movement. We tend to maintain our bias for a sideways motion for the pair. It's characteristic of the movement of USD CAD, of how the pair rose. We had conflicting fundamentals on Friday afternoon. As on the one hand, we had very strong employment data from the US, which supported the US dollar. On the other hand, we had rather weak employment data for Canada. They were both released at the same moment, causing practically USD CAD to jump. But, and that's nice to observe, that the pair very quickly corrected lower. There was some hesitation, but at the end of the day, yesterday, Monday, it returned back even a little bit lower than the levels it was trading before the release of the US employment report on Friday. So practically, we tend to maintain a bias for sideways movement of the pair between the 1.2945 and the 1.2780. In my opinion, to break this sideways movement, either to the upwards or the downwards, we would require fundamentals to be continuous and to support unilaterally the one side of the pair, either the US dollar or the CAD. And that could drive the pairs decisively higher or decisively lower. For the time being, once again, sideways movement. Note how the RSI indicator is running just below the reading of 50. And I would note that for a bullish outlook, I would require clear breaking of the 1.2945 and for the pair to start aiming for the 1.3075. In the case of a bearish outlook, we would require clear breaking of the 1.2780 and for the pair to start aiming actively for the 1.2685. Note the sideways motion of commodity currency CAD, and this could also be related to oil prices. Let's have a look at WTI, which is one of the main export products of Canada. Note that WTI has risen a little bit, and that may have contributed also to the correction lower of USD CAD, which we have mentioned before. But overall, the picture is of a sideways movement. And it's characteristic that it has broken the downward trend line, which has been guiding it since around the 29th of July. So we tend to maintain a bias for a sideways movement. Currently, WTI is trading just below the reading of $90 per barrel. And we would expect the sideways motion to be maintained between the 0.9260 resistance line and the 87 support line. Especially the support line was extensively tested here. Should the bulls take over, we may see the price action breaking this 92.60 resistance line and start aiming for the 100.65 resistance level, which was also tested once, twice, three here. To the downside, and should WTI's price drop, which is also a possibility given that it seems that Iran and the US and Europe seem to be nearing a possible deal about the Iranian nuclear program, which practically would reintroduce Iran as a major oil supplier in the international oil market. That could weaken oil prices, in which case we may see oil price dropping, breaking the 87.20, and start actively aiming for the 82.60. There are also fundamentals which could drive oil price higher. And one such example would be the possibility of the US dollar weakening substantially. That could drive oil prices a little bit higher. Okay, let's move now back to the commodity currencies. We have made an analysis of USD CAD. Let's have a look at AUD USD, which has a different direction totally. Note the wide rise of AUD USD after the correction. Overall, though, it's interesting to note three elements. The first element is that AUD USD on Friday dropped heavily at the release of the US employment report for July. Why? Because the US dollar side strengthened. On the other hand, though, the price action moved decisively higher, maybe some hesitation here, similar to the cap, but rose substantially. And that's an indication that Aussie traders have regained their confidence. Now, some people have suggested that the resistance line could go a little bit higher above the 0.6980, and in such case would be somewhere here, but I would still prefer it to be a little bit lower. Yeah, as it was with the tests, and I would be keeping it that way. Some slight readjustment though could be possible somewhere here. Although that would be meaning that would be the 0.6975. That would be a new support line. Note how it provided support in the past 24 hours, and it seems to be valid. Let's turn this into a green color, and let's go hunting now for a new resistance line. Okay, we have to find a peak here. That would be the most obvious one. But I think we still have mid levels somewhere here. Peak here, and another peak possibly around here. On the other hand, another suggestion would be somewhere here, encompassing this sideways movement here and this resistance levels here, or even a little bit lower, continuous peaks. That would be another level. I'm going to be keeping this as a first possible stop. And that would be the red piece 72,000, 0.72. Nope, too low. Too low. Seems good. 72.05. Okay, you understand that we're talking about 5 pips here. It's not much of a difference. I'm keeping the round figure. Also providing support here. Resistance here, support here, some resistance here and commotion. The next possible level could be here. Definitely. Okay, let's make the readjustments. Now, there is a good chance of AUD USD be driven lower in case the Aussie weakens, and fundamentals for such a scenario are quite plausible. Practically, we would be talking about the possibility of the US-Sino relationships, the tensions in the US-Sino relationships being escalated further, which may weigh fundamentally on the Aussie, given that Practically, the Australian economy exports a wide number of raw materials to China and products. So that would be something to take notice of. And keep your eyes out for the possible surprise drop of the USD. On the other hand, the expectation for a possible slowdown of the US CPI rates for July could drive the pair AUD-USD higher, as it would weaken possibly the US dollar side. For the time being, we tend to maintain, and that's a good question, whether that's going to be a sideways bias or a bullish outlook. Let's see what the trend line says. Okay, trend line seems to be forming, yet it's being put to the test right now. Now, should this upward movement be maintained and the pair starts aiming for 0.7045, possibly even breaking it, that could be a clear indication for a bullish outlook and the continuation of the upward trend line. And the upward trend line is there to show you practically two elements. The first element is that if it's broken, it's a signal for a trend reversal. If, on the other hand, it's being maintained, that tends to imply you the limitations of the corrections lower for the pair, and there will be corrections. For the time being, we tend to maintain a bullish outlook. We would require, though, to see how the market will be behaving against this upward trend line, which has started to form. It's very fresh, it's very uncertain. However, one could argue that this correction lower provides some limitations and the movement right now. Once again, should that be maintained, should the upward movement be maintained, the upward trend line be maintained, remain intact, we may see the price action rising, aiming if not breaking the 0.7045, which provided some resistance around here. On the other hand, should the stabilization be maintained, we may see the price action remaining above the 0.6975, yet break the upward trend line and remaining on the spectrum here. Even I wouldn't be surprised to see it on two possible scenarios. The first scenario is remaining between the 0.7045 and the 0.6975, or we may see it revolving around the 0.6975 as an axis. The RSI indicator is above the reading of 50, slightly upward slope, yet that could correct easily. So it may imply some slight bullish tendencies, but it's quite uncertain in my opinion. It could also resemble a sideways movement here. We'll have to wait and see how the market will evolve in the next 24 hours here. Maybe even soon. Okay, that should sum it up from all of us here at IronFX for today. Best wishes for solid trading.
Hello, my name is Christina. In this video, we will focus on what is trading plan, what is so vital in trading, as well as how to develop one. A trading plan is your guidance that helps you stick to your risk appetite, level of confidence and discipline, as well as your mindset towards winning. In fact, it is your right hand in achieving your trading goals through a well-structured and balanced way. Trading with a trading plan is usually linked to successful trading results. In most cases, Failing to build one usually leads to failing to trade successfully. There are 3 key components in developing a successful trading plan: a solid trading strategy, money risk management, good mindset. The trading strategy or method will give you information regarding which instruments to purchase or sell, or which is the most appropriate time to do so. In other words, it specifies the type of trading system that you're implementing, as well as the types of products you're trading, including forex, commodities, and more. It also gives information regarding the time frame you use to trade and your trading setup, including indicators or stop-loss orders, etc. Money management is of high importance as it specifies the amount of risk you're willing to take in each trade. It also involves placing stop-loss orders in each trade and the right position size as well. A proper mindset will help in controlling your emotions. To achieve this, you can consider the maximum amount of money you can lose if things don't go as expected. Therefore, always risk what you can afford to lose. A proper mindset would also control your greed by setting the maximum amount to gain. All in all, a good mindset enforces your discipline by calculating all possible scenarios and results once entering a trade. If less things are left unknown, the emotions are blocked and discipline is enhanced. Thank you for watching. Stay tuned for part 2.
Okay, so welcome everyone once again to our webinar today. We will be doing advanced moving average strategies. We're going to go through advanced moving average. You guys already know moving average. This is the most simple form of technical analysis. I personally, when I just started trading, this is the first indicator I've ever learned, and you guys will be surprised. I paid quite a bit to learn this because I signed up for one of those crazy trading courses. Nowadays, things are free, like you guys join this webinar for free, right? Yes, so back then I had to pay like thousands to learn the moving average. I know how ridiculous that sounds. Okay, let's do the disclaimer first. So just a warning, a reminder that whatever I share in this webinar should not be construed as trading advice. It should only be taken as educational. Okay, this is only an educational webinar. The whole point of this webinars by IronFX is to help you guys grow as traders. Okay, it is to help you guys grow as traders. Right, please don't take it. There's no signals, there's no forecasting here. Okay, if you guys are waiting for the entry, the take profit, the stop loss, you're not gonna find it in this webinar, because we can advise you when we think it's a good entry, but ultimately it's your choice. Another reminder, trading forex and CFDs carries significant risk and may not be suitable for all investors, right? So do be cautious, especially if you are new here. The risk multiplies immediately, especially if you are going on leverage or margin, right? So please do be cautious. For those who are new here, do not jump into the ocean without first learning to swim. Okay, for those who don't already know me, I think I've taken you guys once or twice before, right? For those who don't already know me, my name is Cass. I am an investment analyst and a prop trader here at Everest Fortune Group. So Everest Fortune Group, we're an award-winning research firm based in Singapore. We're a fintech company. Okay, what we do, we heavily research on strategies, back testing, and we advise the banks, brokerages, financial institutions, hedge funds on where we think the markets are going. So we do a lot of research on the characteristics of the market, where it's going, how it reacts, and blah, blah, and we try to find strategies to overcome that. And like today, we are going to share the strategy that you can use with moving average. Okay, so Average Fortune Group, we've won, we're the finalists for the best forex and best equity research for 2019, 2020, and 2021. Back to me, sorry. I personally am managing quite a, actually it's way more than 300,000 now. Okay, I'm managing quite a bit of funds, way more than 300,000 US dollars on my own personal account. That's me as a trader. I've passed FTMO twice, and I've passed my forex funds twice. So for those who don't know what these are basically prop trading tests that requires you to have a 10% profit within the month. Okay, so I've done that consistently month after month, and hopefully as I go with you in this webinars, I can show you guys how I manage to do that 10% every month. Okay, cool, everyone, cool for now. Okay, I'm gonna move on. Okay, so our agenda for today will be to understand what moving averages are. Okay, and then we're gonna look at some of the common moving averages out there. We're gonna look at two today, and we're gonna look at the natural moving average. So natural moving average is a kind of strategy, moving average that we use here as Average Fortune Group. If you Google natural moving average, you won't be able to find a lot of information on it, because why? I think it's kind of a bit like it's something that we invented in a way, the natural moving average. Right, so this is because I was saying we spent a lot of time back testing and looking out for strategies and patterns on the chart. So we found that the natural moving average is a strategy that works very well on when it comes to trading. Okay, so just bear with me, we will get to the natural moving average towards the end of the slides or midway of the slides. And lastly, we'll be identifying reversals with the natural moving average. And if we have enough time, right? If we have enough time, we will be moving to trading view so that I can show you guys ultimately live examples of how this will work. Why? Because look, I love doing this webinars for you guys, right? It's a lot of theoretical stuff. It's a lot of textbook stuff, you know what I mean? So I can tell you what the moving average, the definition of the moving average. I can tell you the calculation of the moving average, blah, blah, blah. I can tell you so much about the moving average, but ultimately, if you don't know how to apply the moving average, it would still not be useful. You know what I mean? If I give you a pen and you don't even know how to do what to do with the pen, you don't even know how to write, that pen will just be obsolete to you, right? So ultimately, we will try to go to trading view if we have time to kind of apply the moving average and see how it works. Okay, so before I move on, can you guys just let me know in the chat box if any of you use the moving average to trade? Have you ever heard of it, at least, the moving average? No, no one? Okay, thank you, Lola. No one has ever heard of moving average. It's the most, I try but don't understand. Okay, yes, we got a lot of yeses, yes. This is not unusual because, again, I said it's one of the most common indicators. I only look at it at a very basic level. Yes, me, myself, personally, I only use moving average on a very basic level, and I'll show you guys why later on towards the end of the webinar. Okay, so moving average, when I just started using it, I learned it very simple. Okay, if price, let me grab my pen so I can show you. So when I went for these crazy courses where I had to pay so much money to attend, the guy basically taught me that when price crosses above the moving average, you should get in for a buy. Okay, when the price goes below the moving average, you should get in for a sell. Okay, that's what I learned about the moving average. It works sometimes, doesn't work sometimes. Most of the time, it doesn't work that well. Okay, that's why you should never use, although today's topic is moving average, I must say because like every week we'll go through different topics, right? Sometimes we'll go through moving average, Ichimoku, trend lines, support resistance, whatever it is. You should never use one technical indicator on its own to look for entry, stop loss, and take profit. It should never be only one to look for your analysis. It should always be a combination of all things to look for your analysis. And I want to use this example, which I am sure you guys heard when I took you the last time. It's the same as like you're going to a mall, you're buying a pink dress, okay? You see the pink dress, you don't know if it's good or not. So if enough people tell you that the pink dress is nice, you are going to buy it, right? But if everyone keeps telling you it's a no, you're not going to buy it. So it's the same as like you going to your dad, hey, does this dress look nice on you? And then your dad goes like, yes, it does look nice on you. And your mom says, yes, it looks nice. Your sister says, yes, it looks nice. And your brother says, no, it doesn't look nice. Okay. So similarly, when we're looking for trades and setups, we need different technical analysis to give us data and, well, not opinions, but more like analysis, right, of where those technical analysis think price is going. So if enough technical analysis is telling you that price is going up, you are going to get in for a buy. If enough technical analysis is telling you price is going down, you are going to get in for a sell. Okay, right? So moving average is just a tiny part of your entire analysis. Okay, it is maybe your dad. When you ask your dad, hey, is this dress nice? Moving average will tell you yes or no, it's nice or not. That means moving average will tell you it's a buy or if it's a sell. Okay, support resistance will be your mom. Okay, trend lines will be your brother. Okay, and so on and so forth. Okay, so again, moving average is just a tiny part. So let me explain what moving average is in a very textbook definition, right? Again, I'll go through all the textbook stuff, all the theoretical stuff with you, but ultimately you need to be able to grasp. Hey, Fauzan, welcome to the webinar. You need to be able to grasp how to use this indicator, the best way to use this indicator. You can know this in and out, but if you don't know how to apply it, there's no use. Okay, so let's go through the textbook definitions and all, a little basic backstory on the moving average, and then we will try to go into applying it. Okay, so a moving average is a technical indicator that market analysts and investors may use to determine the direction of a trend. Okay, it sums up the data points of a financial security over a specific time period and divides the total by the number of data points to arrive at an average. Okay, it is called a moving average because it's a continually recalculating based on the latest price data. Okay, to put that in the most simple terms that I can think of, right? That is the most textbook definition you can think of. Let's say you see all these candlesticks, okay? If you put your moving average settings to 5, it's basically taking the price of the last 5 candles and dividing it by 5. So it's basically the average of the 5 last candles. If you put the settings at 20, it's the average of the last 20 candles. If you put it at 100, it's basically the average of the last 100 candles. That's why you can see most of the time the moving average is there a best moving average? You know, when it comes to technical analysis, I don't think there's ever a best of anything. It's whatever works the best on whichever time frame and whichever charts you are looking at. So I'll give you an example. There are certain pairs, there are certain forex pairs on certain time frames works well on a strategy that we have found here at Evers Fortune Group. It's called the Nike Tick strategy. That's a totally different webinar. Okay, we found that that strategy works very well on gold. Okay, but that same strategy does not work very well on AUD USD, for example. Okay, so there's never a best of something. There's always which works best at that particular time frame and that particular pair and that particular instrument. Okay, that's why backtesting and research. I have to say, I don't think trading is hard. I think it's a very simple thing. You can probably teach it to a 12-year-old and they will be able to get trading. Like, what's so hard? You just buy and you sell, you put a stop loss and you take profit, right? It's not hard. The hard part is the time consuming part is actually backtesting and learning how to trade. That is the time consuming and the hard part, to be able to grasp and be able to collect all this data. Okay, so that I think is the harder part when it comes to trading. Okay, I hope that answers your question. So okay, let me continue with the definition of moving average. So analysts use the moving average to examine support and resistance by evaluating the movement of an asset's price. A moving average reflects the previous price action movement of a security. Analysts and investors then use the information to determine the potential direction of the asset price. It is known as a lagging indicator. Yes, moving average is a lagging indicator because it trails the price action of the underlying assets to produce a signal and show the direction of a given trend. Okay, I'll tell you guys, when I started using the moving average, I was not making a lot of money. This was when I just started trading. Okay, why? Because the moving average is a lagging indicator. It gives you information that is slow. Okay, so in the beginning, when I was losing a lot of money in trading, I was thinking to myself, this indicator is so dumb. Why is anyone even using this indicator? You're only right like 4 times out of 10 times or 3 times out of 10 times, whatever it is. And the times that you are right, you don't even make that much. When you lose a lot, okay, whatever it is. I was blaming the indicator. So now that I've learned as I grow as a trader, it's not that the moving average is completely useless. It's just like, maybe right now I find that I really love the Ichimoku cloud indicator, right? So to me, the Ichimoku cloud indicator is a Ferrari, and the moving average may be like a maybe a mom van, for example, maybe a van. Okay, so if you were to race, obviously the Ferrari is going to win, right? But it doesn't mean the van is completely useless. The van is still going to get you from point A to point B. It's just that the van is going to get you from point A to point B. It's more fuel efficient, maybe. It gives you more room. You can fit more people in the van compared to the Ferrari. So every indicator has its pros and cons, okay? So the moving average as well has its pros and cons, even though it is a lagging indicator, and we will look into that. Okay, so a moving average is a technical indicator that investors and traders use to determine the trend direction of securities. It is calculated by adding up all the data points during a specific period and dividing the sum by the number of times periods. The average moving averages help technical traders to generate trading signals. Okay, again, the general thumb of rule is if price breaks above the moving average, you are bullish. If price breaks below the moving average, you are bearish. But in this case, you can see how it didn't work out here. It wouldn't have worked out here because price was moving sideways. Okay, so that is the definition. The common moving averages out there. Today, we are going to look at 3 kinds of moving average. One is, oh, sorry, I don't know why I put the weightage moving average in there. We're not going to be looking at weightage. Okay, we're going to be looking at the simple moving average, which is the most common moving average out there, and the exponential moving average. Okay, so this is basically the calculation. When I look at it, I don't like, I know if I refer to my notes or whatever, I know what it means, but just one look, I wouldn't know, and that's totally fine. Again, more importantly is how you apply the indicator. More importantly, you don't know how your clothes are made, right? You don't know how electricity works, right? But you know how to turn on the switch, right? You know how to turn on the switch to use the electricity. So the same, this looks very complicated. More importantly, we need to know how this works, okay? So let's start with the simple moving average. The simple moving average is a straightforward technical indicator that is obtained by summing the recent data points in a given set and dividing the total by the number of the time period. So traders use the simple moving average indicator to generate signals on when to enter and exit a market. And SMA is backward looking, and it relies on the past price data for a given period. It can be computed for different types of prices. So for example, you can get it from the high, the low, the open, and the close, okay? In financial markets, analysts and investors use the SMA indicator to determine buy and sell signals for securities. The SMA helps to identify support and resistance price to obtain signals on where to enter or exit a trade. When generating the SMA, traders must first calculate this average by adding prices over a given period and dividing the total by the total number of periods. The information is then plotted on a graph. So the formula for simple moving average is written as, this was a calculation. Let me go back to the last slide. This. So yes, this is basically a calculation, okay? It's basically, let's say you choose 5, right? Let's say you choose your period as 5. So let's say the first price was 1, 2, 3, 4, and 5. Okay, you add 1, 2, 3, 4, and 5 together, you will get 15. Okay, and then you take 15 and you divide it by 5, you will get 5. Okay, so that's basically how you calculate the moving average. It's just the average of the period that you chose. Okay, it's as simple. It's basically the name. It's just the average. And why is it called moving average? Because it's literally a moving average. Okay. So A is the average in periods and N is the number of periods. Okay, everyone good? Gonna move on to the exponential moving average. Okay, so the exponential moving average, which gives more weight to the most recent price points to make it more responsive to recent data points. So the exponential moving average is not as lagging compared to the moving average. Okay, an exponential moving average tends to be more responsive to recent price changes as compared to the simple moving average, which applies equal weight to all price changes in the given period. When calculating the exponential moving average, the following 3 steps are used. Let me show you the calculation again. This is the one, C minus P times 2 over N plus 1 plus P, okay? Okay, so yeah, 3 steps that I use are, number 1, you calculate the simple moving average for the period. The EMA needs to start somewhere. So the simple moving average is used as the previous period's EMA. It is obtained by taking the sum of the securities closing prices for the period in question and dividing the total number of periods. Okay? It's similar to the simple moving average, but you take the price from the close. Okay. Number 2, you calculate the multiplier for weighting the exponential moving average. So the formula for calculating the multiplier is as follows. Multiplier equals to 2 divided by the selected time period plus 1. So for example, if the time period is in question is 10, the multiplier will be calculated as 2 divided by 10 plus 1. Okay, so the 2 divided by x plus 1 is fixed. I'll just quickly go back. I know this is, so 2 divided by n plus 1. The n is the variable that changes, okay? And then you'll get your answer. So the last step is to calculate the current exponential moving average. The last step calculates the current EMA by taking the period from the initial EMA until the most recent time period using the price multiplier and the previous period's EMA value. It is computed using the following formula. The current EMA equals to, okay, that formula I showed you guys a while ago. Okay, it's basically the calculations. So what is the difference between the EMA and the simple moving average? Okay, the main difference between the 2 technical indicators is the sensitivity that they place on price changes. So the exponential moving average tends to show more sensitivity to recent price point changes. This makes the EMA more responsive to the latest price changes. The formula for calculating the EMA tends to be complicated, but most charting tools make it easy for traders to follow an EMA, okay? In contrast to the simple moving average, applies equal weighting to all observations in the data set. It is easy to calculate, being obtained by taking the arithmetic arithmetic mean of prices during the time period in question. Okay, everyone okay with the definition? The definition of simple and exponential moving average? Don't worry. Don't worry, when I just learned it, I'm just like, oh, this is so dry. Don't worry, okay. I was there once before. For those who are new here, for those who already learned this, right? For those who already learned this, you're just like, okay, I already know this stuff, right? Then it's how we apply it. Okay, so I'm gonna teach you guys the natural moving average, which is what we use a lot here at Everest Fortune Group, okay? Oh, by the way, if you guys are wondering why I'm from Everest Fortune Group, I probably forgot to mention in the introduction. It's because we have a special collaboration, okay? We have a special collaboration to bring you guys these webinars so that you guys can grow as traders. For those who are already profitable, more information to learn, just a different point of view. For those who are still learning and growing as traders, I'm happy to help you guys be even better, okay? So the natural moving average. When you go on Google, when you look for books on moving average, you always hear people saying, oh, the 100 moving average, the 200 moving average, the 50 moving average, the whatever moving average. My question is, can you guys, for those who use moving average, can you guys let me know what number or what settings for the moving average do you usually use? Is it the 50, the 100, the 200? I see Lola saying that she uses the 10, 60, and 200. Anyone else uses a different number? Okay, so Andrej, I hope I'm pronouncing your name correctly, uses the 50 and 100. We've got Kurt using the 50 and the 200 as well, only because that's what a video said to use. Okay, Kurt, I was using the 50 and 100 as well. It's called the golden cross and the moving average. Okay, right? I was using that as well because, yes, I saw a video that told me to use. Actually, no, it was from that course that I went, the one where I paid a few $1,000s to learn about moving average, right? That guy told me to use 200 and 100. I can't remember what it was. Okay, Philip uses the 15, Kingsley uses the 50, the 100 and 200, and Ola uses 7, 14, 89 and 200. Okay, very very uncommon numbers. Okay, so as the answers are coming in, I see a lot of people saying 50 and 200. Why? Because this is commonly believed to be the best settings to use. Okay, I'm not saying it's not good settings. It's just that here at Everest Fortune Group, we have noticed that, I mean, think about it. Okay, think about it, right? Let's say you are going to a party, right? The theme of the party is Hollywood theme, right? You have this beautiful, I know I use dresses as a lot of my references, okay? You have a very beautiful, mini skirt, for example, and very tall stilettos, very tall heels. That short skirt is something you usually use when you go clubbing, right? When you go to the club, you use that very short skirt or whatever it is. But today the theme is Hollywood. Okay, the theme is Hollywood. So you expect really big, gorgeous ball gowns, fancy wavy hair, whatever it is. Okay, the dress will not, the outfit that you choose, which is a short skirt and maybe spaghetti strap, whatever it is, does not fit the theme of Hollywood theme. Okay, it does not fit the theme. So therefore, it's the same when it comes to trading. We don't believe that there is one number that fits all charts and all time frames. So we actually, when you're using the natural moving average, we actually adjust the setting to fit the chart rather than the chart fitting the setting. Do you know what I mean? Right? I understand 50 and 200 is a very common number when you're using the moving average. I personally was using the 50 and 100, but the 50 and 100 does not work on all charts and it does not work on all time frames and all pairs. So the 50 smoothen 10 LWMA low price. Is this okay, is that a setting that you use, Henry? right? So we've got different answers. So which one do we use? We have found that the best settings to use when it comes to moving average is to use the moving average that fits to the charts. Okay, so let me try to grab my pen. I actually tried to use a pen. I can't really find the pen. Okay, draw. I think this is it. Okay. Here. Oops. Just give me a sec. Let me just clear out. Okay. Can you guys see that this is what people usually use, right? People usually use the 50. When we look at the charts, the 50 looks like this, okay? The 50 looks like this, right? But you can see that there are times where price doesn't really touch the charts, okay? It doesn't really touch the charts, right? So a lot of times when we're using moving average, a lot of traders, okay, there's two very simple and known ways to use the moving average. One is when price breaks above the moving average, you enter for a buy, right? When it breaks below the moving average, you enter for a sell. Okay, that was one of the most common, the easiest thing, the most common thing you hear about the moving average, right? Okay, the other way is to, when price comes back to that moving average, the moving average itself works as a form of support and resistance, okay? The moving average itself works as a form of support and resistance. So every time price comes here, the trader will look to get in for a buy here, look to get in for a buy. When it comes here, look to get in for a buy. It goes up, it comes back, look to get in for a buy, okay? So that is the other way to use the moving average. Give me a sec. Okay, that's the two ways. So dynamic and support resistance. Yes, correct. That's correct, said Henry. Okay, Karim is asking what's the best moving average to trade on, the 50 minutes or the 1 hour? Okay, when it comes to moving average or any kinds of technical analysis, again, I need to remind you guys that the best moving average that you should be using is the one that fits perfectly onto the the one that fits well on the chart and is effective on the chart. So I would say the moving average is effective on both the 15 minutes and the 1 hour, depending on the settings. Okay, it depends on the settings, right? It can work on all charts depending on the settings. Okay, so let me just erase everything. Let me just erase everything. Sorry, I need to just give me a sec. Okay. Okay, so this is the 50 and this is the 46, right? Can you guys tell me, if you were to get in for the bounce, which charts would you prefer using? Just give me a while, Karim, I'll answer your question in a while. If you were using the strategy, right? If you were using the strategy where you wait for price to come back and you get in for a buy here. Every time price comes back and you get in for a buy here, which charts would you trust more, A or B? Would you trust chart A or chart B more? Okay, yeah, definitely the 46. But 46 is not a common number used for moving average, right? It's just a random number that we chose. Okay, I see someone saying B. Okay, actually why we choose A is because, remember saying the moving average works as a support and resistance, right? So every time price comes back to that support, you expect to get in here for that buy. But can you see here? This is the exact same charts, okay? It is the exact same charts. It's just that the settings was tweaked. The settings for both moving average was changed a little. This one, whoops, let me go back. This one is the 50 and this one is the 46, okay? We manually went into the settings and changed it to the 46. Okay, we manually went to setting and changed it to 46, and we can all agree that the A looks better when we're looking for entries. Okay, A looks better when we're looking for entries. Why? This is the exact same chart. If we were to use this chart, if we were to use B to get in for a buy, right? Think about it. If we were to use B to get in for the charts, B didn't even touch the moving average, and we would have missed this buy entry here. Whereas here on the A charts, okay, whereas here on the A charts, price nicely touched the moving average, and you enter here for the buy. Okay, so this chart is more accurate. We can safely conclude that the A chart is more accurate compared to the B chart. So whenever we are using technical analysis, to make our decision making, we need to take note, okay? We need to take note that our only job as traders or analysts is to try our best to find the most accurate information, okay? To try our best to find the most accurate as possible information. And there's no black and white written anyway to say that, oh, you must use it this way, you must use it this way. The best way to use something is whatever way that you find is effective, okay? So we have found that this is the most effective way to use it, okay? Okay, let's, let me just remove all the drawings, sorry. Okay, bonus, combining moving average with other strategies. Sorry, this is not the one we're supposed to identify reversals with the natural moving average, and that is exactly the strategy that that is commonly used, which is to buy, get in for the buy. Whenever price comes to the moving average area, you get in for a buy. Whenever price gets into the moving average area, you get in for a buy, the support and resistance. Okay, so looks like we still have about 20 minutes. We can do the bonus, which is combining moving average with other strategies. Okay, so let's move on to the live charts, right? Let's move on to the live charts so that we can apply what we learned today, okay? Give me a sec, let me exit, let me share a new screen. Since we're doing a practice, we might as well try to find a setup. Can you guys, if you guys have any requests for any particular pair or instrument, do let me know in the chat box, right? If not, I'm just gonna randomly choose one. Okay, I'm just gonna randomly choose one. Let's do maybe sugar. Okay, that's a really, any forex pairs? Sugar is a very uncommon. Okay, I think sugar is a future, it's usually a future chart, right? Okay, let's see how well, maybe let's do GBP NZD instead. Okay, let's do GBP NZD instead. Let's try to do a forex pair, because one thing about the sugar chart, we can do it, but because it depends on the chart you use as well, right? This chart particular, I wouldn't want to use this because there's a lot of gapping. It's probably because it is not a 24-hour chart. This chart is closed. Okay, let's try to do GBP NZD. I see a request on BTC USD. Would love to do that. I am a crypto trader myself. Okay. Okay. One thing about the moving average that you guys might want to know is that the moving average works very well on trending markets. Okay, it works very well on trending markets. You can see here that market is kind of going sideways. There's a little bit of a triangle going on, right? There's a little bit of triangle going on, but it works better when it is ranging. Okay, it works better when it's ranging. Okay, so there's two strategies that I will be showing you guys. The first one is to use correlation. Okay, look at the charts that we chose. We chose GBP NZD. Okay, we chose GBP NZD as the chart. So can you guys let me know in the chat box, do you know what pair is closely related to GBP NZD? What forex pair is closely related to GBP NZD? There is correlations with pair. It's the same with USD, the Canadian dollar, and oil. Why? Because Canada is a very big oil producing country, right? So the GBP is very closely related to, yes, thank you so much, Kurt. Yes, the GBP NZD is very closely to number one, the GBP AUD, because the AUD and the NZD is very correlated. Okay, for those who are not sure, you can just go currency correlation strength. Okay, just go to my FX book. My FX book is a good one. Okay, this is where you find correlation. Okay, let's say you're looking for the GBP EUR, actually the GBP NZD, okay? The GBP NZD, when we compare it to the EUR NZD, you can see that there is 89.6% correlation. It's very, very correlated, okay? Because the GBP is very related to the EUR and the AUD is very related to the NZD. Okay, so one way we can use the moving average strategy is to use correlation, but then again, you can use correlation with a lot of things. How you do that, you see this plus button, right? You can plus, click on that, add the correlating pair, which is the GBP AUD. Okay, we're gonna add that in. This is not the one that I wanted. GBP AUD. Sorry, just give me a second. I'm trying to add in another chart. Okay, so you put it as new panel, new. Okay, and it will show below it, right? It will show below it. Just go into settings and change that into, just change that to, I want to change this to a candlesticks pattern chart. Okay, these settings are tricky, it doesn't matter. You can see the price action going on here. Okay, now we're going to pull out the moving average. We're going to pull out a moving average. Why? Because this is our topic for today. So we'll be focusing on the moving average. Okay, on this, we'll be pulling out the moving average as well. Why isn't this coming off? Okay, guys, I think it's much better if I just open another screen. It'll be much faster if I just open another screen. Usually I can compare both charts. It's just somewhere in the settings that I don't see today. Okay, so one of it is GBP NZD and the other one is GBP AUD, right? Okay, we're gonna go into charts. I'm gonna get rid of this since it's not helping. And we're gonna see how correlated this pair is to each other. Okay, we're gonna see how correlated this pair is to each other. The more correlated it is, the more we want to use it. Okay. I'm gonna get rid of this. Okay, again, this chart was not the best to chart on anyways. Okay, we want to see what is happening on both charts. we want to see what's happening on both charts. So this is the GBP AUD and this is the GBP NZD. You can see that from here, price broke kind of like the moving average to the downside. So naturally, you want to enter for a sell, right? Just using the moving average, you want to enter for a sell. But you can see from the past, every time it broke the downside, it was a fake out. It comes back and fakes out. It comes back and fakes out. So what can we safely conclude? It breaks here, it goes up, didn't really give you a good move, and it came back down, broke it. Okay, you would have been able to caught very small moves. What does this tell me when I'm looking at it? It tells me that the moving average doesn't work very well on GBP AUD on the 1 hour time frame. Okay, let's look at how it works on the GBP NZD. By right, price is supposed to break, go back. Every time it comes here, it's supposed to bounce off. It doesn't bounce off. It keeps breaking and keeps doing fake outs. It keeps doing fake outs, keep doing fake out. It means this is not an effective moving average is not an effective indicator on the 1 hour on a GBP NZD and the GBP AUD at this current point of time. Okay, maybe in the future it'll work well, but at this current point of time, today, okay, today it does not work well. Okay, so let's quickly go and look at another pair, USD AUD maybe. Okay, and the USD NZD. Okay, I just want to quickly show you guys an example of correlation. Okay, the first thing I'm going to do is change this to the moving average, natural moving average. So how do you look for the natural moving average? What is the settings? I think someone was asking me earlier on, Karim was asking me, what is the setting? So we don't have a specific setting because again, we are adapting to the charts, right? We don't have a fixed setting, right? It's not 50, it's not 100, it's not 75, it's not 200. It is not a fixed setting. So the settings that we go for is usually using Fibonacci levels number. So the Fibonacci level, that is the 28, okay, the 28.6, the 32, the 50%, the 61.8%, and the 78.6%. Okay, so these are some of the Fibonacci numbers. We try to use this number and we see how well it works. Okay, so let's say we move it to the 28%. Let's see how well it moves. Okay, do you guys think this is a good number to stick on? Okay, price came here, it broke out, did a fake out, came here. By right, when it comes here, it's supposed to bounce. Comes here, it's supposed to bounce. Okay, no, I don't think this is very good settings. So we need to adjust the settings again. We need to adjust the settings until we find a good setting that works well on our charts. So let's try the 32. 32 is not a good one. 50. Okay, I think 50 will not work. Let's try 61. Nope, doesn't work very nicely. You want to find a setting where price was respecting for a while, and that is the settings you're going to be using. Okay, let's try maybe 70. Okay, I think 70 is not the best. Okay, again, I'm just randomly choosing number because I'm trying to find a number that fits well. The thing about natural moving average, because there's no fixed number that you should be using, you kind of just need to experiment and tweak the settings yourself. Okay, why do I think 70 is a good settings for AUD at USD AUD at this current point of time? Because why? Okay, you can see price broke here, it came here, it reversed. It came here, it reversed. It came back to the resistance, it reversed. Okay, so just using these settings alone, we can safely say that price respected these settings. Okay, only on the first time it finally broke. Okay, it broke, it broke, it broke. It came here. Maybe the settings can be tweaked a little to make the moving average go under. Okay, but that will take a bit of time. We don't have a lot of time left. So let's say I've tweaked the settings to a better number and price was nicely respecting this moving average. Okay, maybe the correct settings would be like 72 or 75, whatever it is. Okay, it comes and reverse here. It breaks this, comes, respected this, turn back, broke, came here, respected this area, bounce, broke, respected this area, bounce, and then it stopped respecting. Okay, so my whole point of showing you this is that you need, when it comes to natural moving average, you need to find the setting that fits well to your charts. Yes, it will take a bit of time to find the correct settings, but you can just randomly jump and hopefully land on one that works. You can start with 10, 20, 30, 40, 50, 60, 70, 80, and see which one works well. So let me try 80 to see. See, the more I adjust, the more nicely it moves naturally. Okay, the more nicely you can see that price came here, reversed nicely. This part doesn't respect so nicely anymore, reversed, reversed, and here it breaks. Okay, so if this continues, if this moving average, this natural moving average is still working good, we expect price to do this, come back and retest nicely here, and then we can get in for a sell. Okay. So the other way, how we use correlation, right? The other way, maybe I can try 88 because that is a Fibonacci level. At 88 doesn't work well. Okay, maybe it's a 70. 70 was probably the, or 80 was probably the best as of now. Okay, now we go to NZD USD. You pull out the exact same settings, which is the 80, and see if that works well. Okay, let's get rid of everything else. Trying to show you, okay, here price respected the 80. This part didn't respect, this part it respected, this part respected, it respected, didn't respect here, didn't respect here. Now it's not respecting. It just means 80 is not the correct settings for NZD, USD, NZD. Okay, that means we need to tweak it again until we find a better one. Okay, 100 is not the settings as well, maybe 120. Okay, 120 looks like a little bit better settings, right? It looks like a little bit better settings. We need to find the best settings for the charts. Why? Because we are using this to get our entry, right? You know what I mean? We are using this to get our entry. And how I'm using correlation. Okay, we only have 5 more minutes left, so I don't really have time to slowly look for the perfect moving average settings. Okay, it does take some time. Okay, let's say the moving average, I'm just going to draw a fake moving average. Okay, let's say you found the perfect settings, okay, and it's respecting price. Okay, so why I use correlation whenever, okay, let's say I found the settings and this is the moving average that I think fits best. Why? Because price came here, bounce, came here, reverse, came here, bounce, came here, bounce, came here, bounce, came here, bounce. So when price comes to my moving average again, I expect it to bounce again. Okay, so why am I using correlation? Because if I expect price to bounce, it means that I expect price to be a buy, right? My bias right now is a buy. Okay, the bias right now is a buy. Okay, so now what I do is I go back to my correlated pair, which is the AUSD, AUD. Oh, by the way, the thing that we usually use is actually the AUD, USD, and NZD USD, but I already typed it, so it doesn't matter. Okay, let's say we have found a very nice moving average to use as well. Okay, and it looks something like this. It looks something like this, for example. Okay. Something like that. So when we're looking at the USD AUD, we are also biased that price is going to come here and bounce. Similarly to USD and NZD. So you're using the correlation on both the charts because, again, when you go to the correlation, you can see that they are, for example, 80+% correlated. They're 87.1% correlated. So the USD AUD and the USD NZD is a very correlated pair. So if your bias for one pair is a buy, the other pair should also be a buy. Okay, do you get what I mean? So that's how you combine correlation with moving average or any other indicator to confirm your bias. Okay, because you know, when I am trading, I think I have won half the battle once I have established the first question. So the first question I always have to ask myself, and I hope I get it right, is price moving in a downtrend or uptrend? Am I getting in for a buy or a sell? Okay. If you got the direction correct, I really think you would have won half the battle already. Imagine you think it's a sell, but actually it's a buy. It's a very, very long buy. So using correlation and moving averages, you are able to confirm the direction that you want to get in on. Are you getting in on a buy or are you getting in on a sell? Okay, that's one. The second strategy that I'm going to show you guys. So the first one is correlation. The second strategy I am going to show you guys is the usual strategy that I use on a daily basis. One is to combine, right? Combine the moving average with support resistance, Fibonacci levels, the moving average, other indicators, and chart patterns. Okay, so the first thing I'm going to do is look for trend direction. I do see price moving on an uptrend. If anyone else sees anything else, do let me know. I only see price moving on an uptrend. In fact, it is moving in an ascending channel. Okay, it is moving in an ascending channel. Okay, now I am going to highlight some support and resistance. Okay, there is support and resistance here, right? There's support and resistance here. Okay, so right now looking at the channel, I am biased that price is going up. Okay, I'm biased that price is going to go up. Why? Because there is bullish momentum. 2, I think price is going to go up here. Why? Because there is a horizontal pullback level here. Okay, 3, why do I think price is going to go up from there? Because when I pulled out the Fibonacci, right, there was the 61.8 lining up on my support, okay, which is giving strength to my support. Okay, that's 3, why I think price is going to go up from here. 4, why I think price is going to go up is because when I pulled out the moving average indicator and I used the natural moving average and I adjusted the settings. Okay, guys, again, we don't have time to find the exact settings for these charts. That is just, you have to toggle with it, right? When I pulled the moving average indicator, there was a moving average here. So I expect price to move down here and bounce here. So the other strategy that I'm trying to show you guys is to combine the moving average with other technical indicators to get an even more accurate analysis. It's the same concept as the pink dress that you wanted to buy. You want to buy a pink dress, you don't know if it's good or not. So you ask your mom. Okay, your mom says yes, your dad says yes, it looks good on you. You ask your grandmother, everyone says it looks good on you. There's only one guy who says it doesn't look, it's your brother. Your brother says it doesn't look good on you. But you're thinking, so many people told me it looks good. I don't care what my brother thinks. I'm going to get the dress anyways, okay? So right now we've got so many things telling us that this is a buy, right? You are going to get into this buy because there's enough reason to believe that price is going to bounce from here. Okay, so you use moving average with everything else, combining with everything else to get an even more accurate analysis. Okay, one thing you need to remember, you need to drill it very hard into your brain, deep into your brain, is that your only job as a trader is to find the probability of whether a trade will work or not. Okay, you want to get in here for a sell. You are now going to use technical analysis, fundamental analysis, whatever it is analysis you have, maybe your gut feeling, maybe whatever it is, whatever you can use to find how probable is price going to come here and reverse from here. Okay, using technical analysis, you will be able to narrow down or give yourself a rough percentage of whether a price is going to work. Because let's say you have established that an analysis is, oh, there's an 80% chance that this is going to be a buy. That means you get in, right? But you see, it's totally different. I think a lot of laymen have a conception that trading is gambling. It is not gambling. It is calculated, collected data and risk management. Okay, the difference with gambling and trading is based on very high probability. Okay, whereas gambling, for instance, you go into the casino, you play blackjack, it's a 50-50. It is a 50-50. Okay, you play roulette, it is a 48% chance of winning. Playing blackjack is a 50% chance of winning. Playing the slot machines is a, I don't know how many percent, maybe 3% chance of winning. Playing, I don't know what other games there is in the casino. I can't even think anything. Okay, the probability is against you. Why? Because the probability is so low, chances of you losing to the casino is higher. The casino always has the upper hand to win you. But when it comes to trading and the charts, you get to use technical analysis and all these tools to narrow down how probable a trade is. If it's probable, get in for a trade. If it's not probable, don't get in for a trade. Save the money and don't get in for a trade. Okay, so that's all. Yes, I would agree. I really love poker. I think poker is a game of skills, right? I would agree. Trading is kind of like poker, right? I would have to say poker also has a lot of luck involved in it, right? But trading is maybe a lot more skills and research. Okay, so that's all I have for you guys today. I will catch you guys again. Thank you so much. I'm glad you enjoyed this class. I'll catch you guys again next week. Thanks for attending. Take care, everyone. Hope you learned something. Yes, more importantly, hope you learned something. That's the most important thing here. Hope you guys eventually will be able to grow your accounts into millions and millions. Okay, so I'll catch you guys again. Bye, guys. Thank you so much. Are you or Desmond taking the trading tomorrow? It should be Desmond. It should be Desmond. Tomorrow is live trading analysis, right? Tomorrow is the live charts, right? It should be Desmond, right? Because I will have another webinar to take, right? But if you guys wanted me to take it, you guys can just write in to IronFX and tell them, just write in, maybe drop an email, say that you prefer me, or it doesn't matter, because me and Des, we can swap any day. It doesn't matter, it's just what you guys prefer, because ultimately, again, we are doing these webinars for you guys so that you guys can learn better. Okay, so thanks, guys. I will see you guys again soon. Okay, bye.
Hello everyone, my name is Emily and today we will go through some trading tips. When you're about to begin trading, the best thing to do is start small. Choose only a couple of trading instruments, familiarize yourself with their past price action, and make sure that you perform technical analysis on multiple time frames. Also, familiarize yourself with their fundamentals. For example, if you're about to trade Amazon, you have a good look at what the latest developments are for the company, but also what events lay ahead that could affect the share's price. Your aim is to eliminate the surprise factor as much as you can. You don't have to risk a high amount. Keep the risks minimized by investing low initially, and don't forget to set up a stop loss order and a profit-taking level. Your aim should be to learn and familiarize yourself with trading, but at the same time to preserve or even increase your capital. So guys, I'm here to give you some ideas on how to accomplish a big goal. First, set your target and time it. Make sure you're realistic and calculated. State how much money you want to make and when you will acquire it. Be specific. Now turn your attention to a big target you have accomplished in the past. It could be a trading winning streak or a single trade winner. Identify the circumstances that contributed to achieving those. What were you trading? Was it moving higher or lower? What direction did you take? Think about what happened then in detail and break it down into sections. This will help you identify the circumstances that work for you. Once you have all of the information down, think of how you can use them again to your advantage. This will help you create a vision in your mind, which will then help you go out and perform. Use as much detail as you can and vision your trading as vividly as possible. The more clearly you can see it in your mind, the easier it will be to manifest. You still have to be realistic though. People have the misconception that they can make huge amounts of money fast and effortlessly. This is a big mistake that the majority of traders make. That's why 90% end up losing everything. Making money as a trader is just like any other job. You have to work hard for it, you have to study, and you have to act fast and accurately. If you study the best traders in the world, they rarely make big profits on a daily basis. They're profitable 9 out of 10 days, but they make marginal profits compared to their balance. If you aim for huge profits, you have to understand the risk you're undertaking. Risk management is one of the most important facets of trading. There is no easy money in trading. Thank you so much for watching us today, guys. See you on Monday. Bye-bye.